Hey guys, Mr. Breen here, and in this video I'm going to be talking about loans. Any loan must have three parts at least. There's the principal, the interest, and the loan's term. The principal is basically how much is being borrowed. So let's say this is a loan for a house. You might borrow for your house $200,000. That might be the principal of the loan. The loan's interest is the percentage that you're paying to whoever's loaning you the money for the use of their money. So maybe the interest on this loan is 2% per year. Notice the interest is not expressed as a dollar amount, it's expressed as a percentage of the principal. The loan's term is how long it's going to be before that loan must be paid back. So maybe the loan has a term for a mortgage. This might be a pretty typical term for a mortgage, 30 years, for example. So this is all fairly simple, and you could do this with any kind of loan. Let's say that just your friend lends you money for, a year. So maybe he lends you, or she lends you $50 at 1% interest, although, let's be honest, is your friend probably going to lend you money at interest? Maybe not, but, and the term would be 1 year. Or somebody could lend out money for 1 week. I'm going to have to write this sort of down here. 1 week, and maybe they lend $10 and they lend. Now the interesting thing is the interest rate, you want to still express the interest rate as kind of an annualized thing. So maybe the annualized interest rate is 5%, but the interest rate per, over a week is something more like 0.1% or something like that. But you still want to do this percentage, this interest rate, on an annual basis. So what are the different types of loans you could get? Well, a lot of times loans are for specific purposes, and it would be very unethical and usually illegal to use the money that you borrowed for some other purpose. But there are mortgages, which are loans to buy real estate. Okay, not just houses necessarily, but maybe a place for doing business. There are business loans, which are meant to be used to expand a business. There are student loans, which are meant to be used to pay for education of some kind, often college education. And there are also auto loans, so loans that are intended for use in buying a car. And who's giving those loans? Well, oftentimes it's a bank, right? So we all know about going to the bank to get a mortgage or a business loan. Okay, a lot of student loans now, most student loans now come from the government, the federal government, and auto loans. But oftentimes auto loans actually come from finance companies, which are often owned by automakers. So these finance companies are actually companies whose sole purpose is to lend out money to consumers for buying big ticket consumer items like cars or maybe a boat or some kind of furniture or something like that. So oftentimes, for Ford Motor Company, they have what's called Ford Credit. And for General Motors, there's GMAC, and places like Art Van have their own finance companies, so you can borrow money from Art Van to buy products from Art Van. Now, loans have a certain problem, okay? And the problem that loans have is that if you lend out money, you can no longer use it, okay? You are what we call liquidity constrained, okay? Liquidity is just your ability to use money or to use something as money, so money is highly liquid, okay? But there are a lot of things that are a lot less liquid, like, a house or a car is not very liquid, or a loan that you made to somebody is not very liquid. But we could fix that maybe if let's say that B is just a guy who's going to lend money to A. Okay, A needs money for something. It doesn't matter what it is, but A is going to hand an IOU over to B, and B gives A money. But let's say, when B made this loan, he thought he was going to be fairly comfortable. He had some money to save, and so, his saving took the form of an investment in A. But now B, something happened in B's life that caused him to actually need some money, but because he lent money out to A, he doesn't have any anymore. Well, that's a little dramatic. He has money, but maybe not enough to cover new expenses that came up. So B doesn't have money, but he does have this IOU. Okay, so what if he could sell that IOU to somebody else, say to this person C who has some money? So in exchange for C's money, he gives A's IOU to C. Now A doesn't owe money to B. Now A owes money to C, and B has the money that he needs. Now there are some ways that we've solved this problem, and you'll see that, but we're going to call this on top the primary market. Notice this is a market for debt, okay? And down on the bottom, this is the secondary market for debt. In other words, the first time debt comes into being, it's sold in the primary market, but that debt itself can be sold to somebody else on a secondary market. Now, lastly, okay, none of this is without any risk, okay? There is always the risk of default, and default is when somebody doesn't pay, that's a U, by the way, somebody doesn't pay their loan back. All right, so if this is the only transaction that's made and A defaults on this loan, then B is going to be sort of stuck, right? Unless, of course, he managed to sell that loan to C before A defaulted on it, in which case C is going to be stuck and B is going to be sort of just fine. But to reiterate, it's called a default if somebody doesn't pay back their loan.